Hello, with me today I have Chris St John, manager of the AXA Framlington UK Midcap Fund. Hi, Chris.
Hello.
The AXA Framlington UK Midcap Fund has outperformed its benchmark index over multiple time periods. Could you just explain how you run the fund and what's made it such a success?
Yeah, thank you very much. I've been running the fund since March 2011, running it with exactly the same investment philosophy and process. And really, I've just been looking at companies that I genuinely believe can sustainably increase their economic output and where balance sheet strength is supportive of that growth. My fund I've run has been diversified. I view equities as risky, so 60 to 90 holdings. Being an equity investor, you need to be patient. So my investment horizon has been 3 to 5 years. In reality, a lot of holdings I've had, I'll hold for much longer than 5 years. And at the moment, the average holding period is 7 years. So there's no big turnover in the fund. And what I've felt a real key to success, I mean, if you look at the sort of constituents of outperformance of the index, for example, it's come from stock picking. But I think that underestimates the work I do on the strategy. And what I mean by that is finding companies that are operating in areas where there are economic tailwinds. An example of this, you think back to a quote from Henry Ford's lawyer back in 1903. He said that the horse is here to stay, but the automobile is only a novelty, only a fad. And that's interesting from two perspectives. One is that experts can get things very wrong. But what it also tells me is it doesn't matter in 1903 how good you were at renting out, owning horses, your business ultimately was going to be destroyed by the car. So it's all about getting behind the headline numbers, stock picking, finding those businesses with those economic tailwinds. And that's what's driven the performance of the fund fairly consistently since launch.
Well, I mean, has the pandemic made you think differently about investing at all, or has it changed your behaviour as a fund manager? Are you buying more stocks, selling more, shifting the balance of your portfolio in any way?
There's been no great change, to be honest. As I say, the average holding period at the moment is 7 years. It's just been a case really of carrying on working at the stock picking, meeting companies, working on those thematics. I mean, we have as a country, and we're not alone in the UK, it's been the worst economic contraction in 300 years, brought about by COVID. And what we've seen, why this is so unusual, is that the economy essentially has been put to sleep by governments. We've been asked to stay at home. We've been asked not to go to, well, depending on which part of the economy you operate in. In many cases, people are not going to work. Where you can, you're working from home. And this has led to some changes in behaviour. Some will be permanent, some will be temporary. The idea of working from home, we as a business are going to be taking on 60 or 40%, I should say, less office space than we've had historically. So we will be working more from home on a permanent basis. And it has led to other behavioural change. People have been spending a lot of money on their homes. There's been a big increase in pet ownership and all the spending that goes around that as well. So no change to fund positioning in terms of a wholesale, but there have been opportunities absolutely that have come about because the stock market has fallen. Something like Pets at Home, which people may well have heard of, a pet retailer, a business that's expanded its footprint. It's in veterinary science, has a fantastic technology platform as well. That was a business that got hit very hard in the outset of the pandemic, gave me a great opportunity to invest in it. And now we're really starting to see that increased pet ownership, the profitability of that business expand. And this amazing change we're seeing across businesses where retailers and other businesses as well are using technology to get much closer to their customers, to understand their customers much better, how they're shopping, how they're behaving, and are in an increasingly strong position in terms of translating that into turnover and profit growth.
And well, we've got the vaccination program underway now. How optimistic are you about the future, and what is the outlook for 2021?
Yeah, I think on the whole, people, me included, are more optimistic from an economic perspective than we were a year ago. I mean, the vaccine, as it stands, on the basis of the knowledge we have, is going to make a massive difference. This is certainly a game changer. Now, in terms of investing and trying to time the market, of course, economic recovery is going to be linked to a certain degree to the success of the rollout, and that's the speed of the rollout. And also the success of it on an enduring basis. And because it's going to have to cope with mutations of this virus, which we're seeing at the moment. Speaking to our biotech team, they're very confident that the new mutations we're seeing will not be resistant to the vaccine. So we remain optimistic that the economy will continue to open up. And the banking system, which is well capitalized, has been supportive of this growth and is supportive of companies' need for capital, which they've needed, particularly in areas like hospitality, where turnover has fallen dramatically. Banks are also there to support businesses, and that gives us a cause for optimism, certainly from an economic perspective. What I would say, as a fund manager and a stock picker, you just need to be very careful how much debt your companies have taken on through the downturn, and how that change in the financial structure will impact the fundamentals of the business going forward. Don't forget, as an equity holder, we are the least preferred creditors, so balance sheet strength remains really important.
Of course. Well, I mean, as well as the COVID vaccine, we now also have a Brexit trade deal. Now we're still in the very early days. We need time to see how that pans out. But I mean, has this encouraged you to increase exposure to certain stocks and sectors? I mean, should we all be buying UK stocks now?
Yeah, that's a very interesting question. I mean, Brexit has led to masses of uncertainty, certainly in the eyes, or particularly in the eyes of investors. If you go back to 2016, UK equities have seen pretty consistent outflows from international investors since that time. The whole Brexit process has led to incredible uncertainty. People didn't know whether there'd be a hard Brexit, whether there'd be a soft Brexit, what that would mean, different types of hard Brexit as well. But we sit here today with a deal in place. Now, the deal in place itself covers goods. In terms of services, more will develop over time. We're hearing slight issues at the moment in terms of paperwork taking a long time to do, so there's some quite high-profile cases, certainly if you read the papers, in terms of food supplies into Ireland being slightly short. I'm hopeful that this is all part of the process of getting up and running. People understand how the forms need to be filled, and I'm very hopeful that technology will at least to some extent fill that gap between what is required and the frictional effect of that in terms of filling out forms and the like. In terms of the UK market, yeah, I mean, it is looking relatively cheap to international equity, certainly. Investors sometimes look at something called a CAPE PE, which is takes a 10-year average inflation adjusted earnings and divides it by the market level. Fairly complicated, but what ultimately that tells you, the number it spits out at the end is a CAPE of 20 times, and that's consistent with 7 to 9% returns per year over the next 10 years. The UK market is definitely trading on a discount to others. We're getting into a great debate at the moment, certainly amongst those with a vested interest to get fund managers like me to trade equities, about growth and value. Interestingly, I was looking at the US market, looking at the ratings, the backward-looking PE on the value and the growth markets, and actually the backward-looking PE in the US on the value market is 20 times. That is effectively a slight discount, and only a slight discount, to the FTSE 250 at the moment. So the mid-cap space where this fund focuses in the context of the US market is actually a value market, which I find very interesting, given the amazing amounts of growth companies and sustainably growing businesses that we find. I mean, there are other metrics to suggest that the UK market's pretty cheap at the moment. We've seen a very big uptick in mergers and acquisitions, companies being bid for on the stock market. We've had companies like William Hill, for example, has been bid for. And what has been noticeable, again, slightly technical, just a spread between, in the mid-cap space, the BBB corporate bond yield and the earnings yield. And quite simply, that just means that you can borrow at a relatively low cost and buy companies which are giving you an income which dramatically covers that cost of borrowing. And so that lends itself to what is commonly termed, particularly in the States, de-equitization, borrowing at a low rate and then buying equities which give you significant level of return. So we expect more mergers and acquisitions to happen on the UK market, and we think UK domestic and international businesses will be of interest to overseas buyers, whether they're corporates or private equity.